So today I'm going to be talking about the worst thing you can ever do when it comes to investing and many other things that will help you prosper in the future. So stay tuned, watch the end of my video so you can know exactly what and what not to do when it comes to investing. Hello everyone, welcome back to my channel. For those who are not familiar, who I go by One Chief Compadre, and you're watching Chief Compadre TV, where on my channel we talk about savings, investing, politics, and even story time. So nowadays things are getting real bad with this use of credit, and we have from student loans to credit cards to car loans to home mortgages, you name it. And we're getting to a place in society where we're dependent on credit. And there comes a time when we have to move away from using credit and using the resources that we have to help build a future for us where we have full ownership of a business, property, having a car, you name it. Now, this title is about beginner investors and what they should not do when they first start investing. But before I talk, I'm not a financial advisor. I'm just someone who invests, and from experience and from history, I know a few things when it comes to investing. So I'm just going to share what I know to help you improve and become a smart and knowledgeable investor. So you want to use credit to help fund those endeavors, but after it'll come a point in time where we got to deviate from using so much credit and start using the resources that we have. Even if this is a few $100,000, at least when people want to invest in you, they see that you are serious about investing in your company. If you have a stake in your company, then maybe you can get more investors. But if they see you at a risk and that you owe money, they may look at you like maybe you're not serious about your business, and they may not want to invest. Where you can show them that you are serious about your particular company where you putting your own money into it, and then they may want to invest in it as well. So when it comes to investing, my number one rule is never, ever, ever use borrowed money to invest in the stock market. Because everyone knows that when it comes to the stock market, that you're not guaranteed to make any money. When you put money in the stock market, it's money that you have to say to yourself is already lost. So if you make money off of it, then you're headed in the right direction. But you definitely want to be putting in money that's from you. And it doesn't take a lot of money to invest in the stock market. You can start with a few $100. It doesn't have to be a person who makes $100,000 a year and has saved up $100,000 and then you invest. No, you can start with a couple $100. You don't need to give your money to somebody else to invest. You can do it all on your own. You can just open a broker's account, link it to your savings or checking account. Once you do that, you can start watching CNBC or go to Google and type in whatever you want to invest in. If you have a goal, if you're a day trader or you're a long-term investor, then once you decide that, then you can type in, okay, I want to look up individual stocks, or I want to look up ETFs, I want to look up mutual funds. I want to look up index fund, whatever you want to look up. Type it in. Once you find it, read through there, find the research, find out if they're in debt, find out if they have more cash on hand than liabilities, assets versus liabilities. Once you determine that, your goal is then you start invest, and then, you have to start learning. If you lose money, you got to learn from your mistakes. That means you may have to take your money out of that account, out of that company, and then take it in another company that may work out for you. Because when I first started, I was investing in individual stocks, and I would see it fluctuate from going up and down, and I was just thinking to myself, you know what, maybe I just need to find another better way of investing. And then I came across ETFs, and I've been sticking with ETFs ever since, because every month you get paid even in your sleep, and then you can reinvest it by clicking on Drip, and Drip will reinvest that income you get each month, reinvest in your company. And at the same time, you're automatically putting money each month. When you get paid or whatnot, you pay yourself first. All that gets reinvested back into that particular companies that you invested in, and then you just do like never-ending cycle each month. So you really don't need to take out loans or credit cards and use that to invest in the stock market. You just start with a few $100s a month, and the younger you are is the better, because you have time on your hand. And when you have time on your hand, you are more able to make even more money over time due to compound interest. So if anyone ever tells you to take out credit or a loan or borrow from a broker or a bank to invest in the stock market, run, avoid them, because many of these people, they're just gambling, they're taking risks. Even though when it comes to investing, there are risks, but there are some risks you don't have to go through if you just do it the right